Dr. Lacy Hunt predicted at what time inflation will drop back down to 2%. If the Fed keeps on raising rates and quantitative tightening. If you were questioning the Fed's ability to control inflation, you probably haven't paid attention to the latest CPI trend. Even though the Fed can't print oil, food, and services, the Fed has the power to cause demand destruction, causes companies to lay off workers, killing the demand of home buying by raising mortgage rates, thus killing the housing market, making the wealth effect disappear. Because most people have their wealth tied into their home value. Most people have less in the stock market or bond market. The Fed can really change all of these markets with their most powerful tool, their speeches, making people spend less and causing a recession, which will bring inflation number back down to 2%. The question is when? What time will the inflation genie be back in the bottle? How much longer do we have to suffer with high prices? Dr. Lacy Hunt has the answer to all of the questions. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit, like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want it to be real. You want it to be true. You need to be my client, don't you? Paul Volcker is widely recognized as the Federal Reserve's greatest chairman. Far less well understood is that he was an outstanding economist with a deep strategic understanding of monetary relationships. These strategies apply directly to the monetary policy situation that the U.S. faces now. He said, I suppose if some Delphic oracle had whispered in my ear that our policy would result in interest rates of 20% or more, I might have packed my bags and headed home. But that option wasn't open. We had a message to deliver, a message to the public and ourselves. The message was that the Fed understood the critical role of money in causing inflation, and that the Fed could not back away from restraining money growth without risking a damaging loss of credibility that once lost would be hard to restore. He goes on to say that due to the work of Nobel laureate Milton Friedman, the public understood the relationship between money, growth, and inflation. He adds, to over-dramatize a bit, we were doomed to follow through. We were lashed to the mast in pursuit of price stability. Did I realize at the time how high interest rates might go before we could claim success? No. From today's vantage point, was there a better path? Not to my knowledge, not then or now. This statement is very telling because Friedman had acknowledged that the relationship between money, M, and economic activity was not as stable as when Volcker was chairman of the Fed. Thus, Volcker and Friedman were aware that the velocity of money is not stable. Thus, to Volcker, even though there was this important missing relationship in Friedman's model, based on the equation that GDP equals M times V, the best approach for the Fed to achieve price stability was to rely on this basic monetary model. Two subjects are of overriding importance in order to evaluate Powell against the high standard set by Volcker. Number one, the paramount importance of achieving price stability as a prerequisite of sustainable economic growth. And number two, the role of money in controlling inflation. Powell is clearly aligned with Volcker on inflation, but not the role of money. As for inflation, Powell, like Volcker, has clearly demonstrated that the economy cannot inflate away its problems, and that such a strategy makes the overwhelming majority of Americans worse off. This is the way that Powell very clearly expressed this understanding in his speech at Jackson Hole on August 26th. Without price stability, the economy does not work for anyone. Without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them. When it comes to money, Powell, in testimony before the Senate Committee on Banking, Housing, and Urban Affairs in February 2021, disagreed very sharply with Volcker on the role of money. In the same hearing in which he incorrectly said that inflation was not a problem anytime soon, he had an interchange with the Senator Kennedy on money and inflation. In response to Kennedy's concern that rapid growth in money would lead to accelerating inflation, Powell replied, "When you and I studied economics a million years ago, M2, and monetary aggregates seem to have a relationship to economic growth." Then he added, "Right now, M2 does not really have important implications, so something we have to unlearn." I guess Powell's statement is totally inconsistent with Paul Volcker's final say on monetary economics shortly before he died. Powell's rejection of Volcker's framework coincided with the Fed ignoring nearly unprecedented liquidity growth in 2020 and 2021, which in turn led to the worst cost of living crisis in 42 years. 180 million Americans suffered the largest permanent decline in real wage, salary, and retirement income since 1980. The size of this pain was far greater than the benefit gained from roughly 6 million new jobs. This major difference is very significant since the Fed has constitutional responsibility for the supply of money. With effective but not total control, money is the closest variable in their arsenal to affect the economic change. By ignoring money growth, as in recent years, the Fed is less likely to know when it is consistent with price stability. Taking into explicit consideration of both monetary growth and velocity, it is possible to calculate when the 3-year growth in liquidity will return to a range consistent with the economy's production function and a 2% inflation rate. This would be in line with Friedman's optimum quantity of money except that Friedman incorrectly assumed velocity was stable and was not taken into consideration. Velocity captures all of the following factors that could influence economic activity other than money. These would include the shadow banking economy, wealth, financial innovation, and most importantly, the productivity of debt and the shifting composition of bank assets between investments in government securities and loans to the private sector. Based on the calculation by the insightful young economic analyst Eric Bamajan, by the end of the first quarter of next year, which is between March and April of 2023, the 3-year rate of growth in other deposit liabilities, ODL, of the banks, a superior alternative to M2, will be consistent with a longer-term trend rate of 2% inflation. Achieving the actual target will be later since inflation is a lagging indicator. This estimation allows for the fact that ODL velocity fell sharply in both 2020 and 2021 and remained depressed in the first 2 quarters of this year. This is based on QT with agency securities that is now running off at $96 billion per month, and a decline in total reserves due to increases in the policy rate. If the Fed fails to complete the promising start to neutralizing the liquidity mountain of 2020 and 2021, meaning if they start to pivot too early between now and next March, Fed actions will result in higher inflation, perpetuation of the cost of living crisis, and a lower standard of living, with greater and longer lasting job losses than if they stay their present course. Okay, now I'm going to show you my client Lee Vincent's book, The 3 Most Important Influencers You Need to Meet. I did write the foreword in this book. Such an amazing book. And my client Teddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel. Such an awesome book. Order your copy today. You are such a good boy for watching my video right till the end. Bye.